Hey, Mike Gerberding here. I wanted to shoot a quick video and just let you guys know how to make money when the markets go up and not lose anything when the markets go down. A lot of people through the years, one of the more common things is, well, geez, that just sounds too good to be true. Because let's face it, the fact is, if you're wanting to retire, protection of principal is vitally important. I mean, if you lose half of what you have in retirement, you're in deep doo-doo. And unless you got lots and lots of money, and even if you have lots and lots of money, usually that still hurts, and that changes the lifestyle quite a bit. So how does that actually work? And I want to talk to you about one of the investments that is really become a huge thing. It's a $100 billion industry. Because it is so popular, and people, they went through 2008 and they don't want to go through it again. And so how exactly does that work? So I'm going to share with you how that works and show you how awesome it is. So there's a few things. Number one, when you have an investment like this, you're not actually in the market. You're just following an index or following a market. An index is like the S&P 500 or the Dow Jones, Euro stocks. There's a bunch of different indexes out there. And so these large financial institutions just allow you to make a return based on an index, but not lose when that index goes negative. So here's a basic overview of how that works. And I may dive deeper in future videos. So let's see if this will work. I'm trying this new recording thing, so I'm not sure if this is going to work, but we'll give it a shot. From current slide. All right. From current slide. Here we go. So I'm going to have to move this over here. What are our goals? Well, our goals, come on, PowerPoint. Maybe it doesn't like me here. I don't know. There we go. Goals. Guaranteed of principal with no risk due to market loss. Now that is a goal. That is a goal for many, many Americans. If you're just an average, hardworking, good American, this should be a goal of yours. We've talked about market loss before and why not risking your life savings in the big stock market casino is pretty important. And if you remember the 2000 crash or the 2008 crash, you should take to heart what you went through, because the next one, as it always does, goes up and down, could be a lot worse. If it's not, then none of this really matters. But if we do go through it and you don't have tons of money saved up, well, this could hurt. So that should be a goal of yours. Guarantee of principal with no risk due to market loss. How do we do that? Potential for market gains linked to an index like the S&P 500 or the Dow Jones, and lock in annual earnings and reset of the new principal. So we'll go into what this lock-in really means and what the reset really means. Okay, I might have to minimize this, get my big face out of there for you. Yeah, here we go. So you start out with 100 grand. Whoop. Start out with 100 grand right here, 100,000 bucks. And we're going to say that the market went up 5%. Boom. So you go up 5%. So now you've got $105,000. Gains become principal. What does that mean? That means that $105,000, you'll never go below that point. You started with 100, you made 5,000. The gain locks in. You're never going to go below that point. That gain is a permanent rate of return. You've locked in that gain. The only way that that's going to go down is if you actually withdraw the money out. It's not going to go down to because of a market downturn. So here's what a market downturn looks like. There you go. Market lost 10%. So if you were in the market, you'd be down to 94,500 bucks at that point. However, we're not in the market. We're just tied to the market or connected to it. So what happens to your account? What does a 0% look like since you've locked in that gain of 105,000? What does it look like? It looks like this. You didn't lose a nickel. There's your 105,000 bucks. You didn't lose anything. You still have it. You didn't take the loss. Now, the market's going to come back up. Watch this. goes up 5%. Now you're getting gains from down here, and the market jumped back up 5. But since you didn't lose anything, you're starting right here at 105,000, and you jump up from there. So now you've got $110,250. So you actually, you're beating the market in this scenario. So that's how it works. So even if the market were to drop even lower, you get the gains from the bottom of the barrel. So this is a beautiful scenario to me. I mean, if you're retiring and let's say you only have 100 grand or 50 grand or whatever it is, to me, if you're retired, you no longer have an income. You got Social Security, you got pensions, you've got all your savings, whatever you have there, it becomes vitally important not to lose it. Especially when you're drawing on it. So that's the basics of how it works. We can look at another illustration here. So here's how the market works real quick. You start with 100 grand. And if you're in the market back in 2008 to 2009, you would have lost. You would have went down to 62,790. And then when the market came back up, notice you're not all the way back to 100. You're only up to 79,400 bucks. And if you had an index annuity, it'd start with 100, the market would go down, you wouldn't take a loss, the market would come back up, you'd end up with $126,400. So you never go backwards. Here's an example of the S&P 500 and kind of how it works. Here's a chart, real common chart. So this green line up here is a fixed index annuity. The blue one is the S&P 500. And we'll show you the red line here is if you had a management fee of what that would look like over this 15-year period of time. So 2001 to 2016. So the red line, there you go. You'd be at 123,000 if you actually had the S&P 500 minus a 1% management fee. This is kind of interesting. 2% management fee, which is a little bit more common. There's your spread. So you know what? Most financial advisors that do not promote these types of investments, they hate this chart because it shows that we're beating the market with a fixed index annuity. And stockbrokers, guys like that, they don't like to hear that. They think that's hogwash and everything else like that. They talk bad about it. That's fine, but this is what it is. I mean, here's your spread. And the fixed index annuity never took a loss. So because we never took these huge losses, you stay ahead of the game. You continue to go up and up and up. I'll show you the actual chart. Let's see if I can get into this. This might work here. So here's where that chart came from. No, I don't have it. Anyway. Well, that's it, guys. That's what I got for you. You know how the index works. You know how not to lose money in the market. You know how to lock the gain in and never take a loss. So that's what I do. I mean, that's a mile high overview. It does get a little bit more complex than that. There's a lot more to it. You can get into guarantees on there. You can get into minimum guarantees. You can get into different buckets of how you can make money. I just got an email here of a company. Look at these returns that they showed me. This is an indexed annuity, which is pretty interesting. Double-digit net returns. Real results demonstrate participation rate power. Are you seeing impressive double-digit rates of return? This is from a Liberty Mark. So here's the returns. This is a 2-year return, but these are safe investments. No risk to these investments here due to a market loss. 17.95%. Look at that, 30.27%. Are you serious? You can make a 30% return. Now, granted, that's over 2 years, so 15% per year, but you never took a loss. Can I tell you how many people I heard talk about, I'm up 20%, or they're up this or that, or when the markets are going really well? Well, guess what? You don't hear them talking now, do you? Because it went back down. So they go up, but then they come down. They call it a paper gain or a paper loss, meaning it's never an actual real rate of return when you're in the market. It's just a fluctuating thing. It's like you're at the blackjack table and you're up and you're down and you're up and you're down. You're never really there. Whereas here, you started with that 100,000, you made a 5% return. It's a real 5%. You get to keep it. You don't have to lose that. it's not going to go backwards again. That's it. It's a real rate of return. Look at this: 30%, 23%, 13.87, 15.63. These are huge rates of return. I'm not trying to say that everyone's going to get these levels of returns. I mean, this is one particular product, and if you happen to have been in those indexes over this time period, you would have seen those returns. But the main thing is you don't take that loss, and you're able to get a competitive rate of return. And then if you want, you can add on guaranteed lifetime income to these types of investments. So that's what it's all about. I think this is better for the average American than being in the stock market. That's my gut feeling, because the market goes up and down. And for the level of savings that I see people having that are retiring right now, that's all they have, and it has to last for the rest of their life, and usually for 2 lifetimes. And we don't know how long we're living. So, if you haven't protected yourself, I would highly recommend that you take a look at this and make sure that you're protecting yourself. And if I can help you, feel free to call me. I'd be happy to help you as well. All right. Hope y'all are doing well. Take care now. Bye-bye.